Alrighty, today I'm gonna do a brief overview of Gap. Um, this equity took a hit the other week based on some headlines that were reported when they were covering their earnings call, some tariff-related headlines, and essentially the company said that tariffs would impact the top line and maybe some margin squeeze, and it sent Gap from about $30 a share down to a low of 21 dollars a share on the 4th of June. So you guys know that I'm not huge into technical analysis. I'm more of my background is in mathematics and finance, and but I do briefly just want to touch on this. This is a good-looking, healthy chart right here. This is 90-day chart, right? You could see this sort of retrace potentially. This is not financial advice, but if tariffs are mitigated, if they find a way to mitigate tariffs, or if tariffs are renegotiated to where they're not so draconian on some of these companies that do a lot of contract manufacturing out of China, you could see a complete retrace here. So that's why I think it's interesting. Um, let's get into the actual model here. So boom. Hopefully you guys can see the screen. It's kind of my first time using OBS, but so it's always nice when you start a model to do more of a segment breakdown. So Gap, they actually operate a franchise model overseas, and within the United States, they own all of their retail locations. So it's something to note. They do an e-commerce business as well, so you'll see a mix of store and franchise revenue, which is U.S. and international retail revenue. Uh, Franchise models essentially work in a sense that the company will license out the right to licensees to sell the brand at various retail locations, and those licensees will then pay a franchise royalty back to uh, the franchisor, which is Gap. They have online revenue, this is e-commerce, and that's it. That's the mix. So I've taken the liberty to sort of model out 2 quarters here. You can see total revenues up 2% year over year. You can see that online revenue accounts for only 30, 40, it's a 60-40 split basically. And here are their brands. You have Old Navy, Gap, Banana Republic, and Athleta. And then you have, ancillary revenue, other revenue. Athleta is very popular among fit women. Banana Republic, business casual. Then obviously you have the staple legacy brands, Gap and Old Navy. Old Navy representing the lion's share of the revenue at 60%. They did 3 billion in. Oh, sorry, that's that's just U.S. They did about 3.5 billion in revenue in 1 quarter, in the most recent quarter ended in May. So, just to give you an idea of the top line. Also did a regional breakdown: U.S., Canada, and other regions. So you can see. Now let's get into the income statement or the P&L. So let's see. Actually, have to pull this up. Give me a sec, guys. First quarter of May, perfect. And I don't think you're going to be able to see the numbers that I'm punching in, but I will do my best to break it down for you guys. I'm just going to enter everything in. Operating income or EBIT. Could just do net interest expense or net interest income, but here we have pre-tax income, right? Obviously taxes, corporate taxes, and you have net income divided by shares outstanding. You have your earnings per share. some formatting here. I hate using my mouse, but I don't have Macabacus anymore, so I don't have all these shortcuts. We'll do this. Oops. Do this. Perfect. All right. This is formatted accounting. Perfect. Okay. Bold revenue. That's really all I bold. Sometimes gross profit. Do EBIT down here. Sorry, EBITDA. Start with EBIT. Add any depreciation and amortization. Which are non-cash expenses. You'll get your EBITDA. You can add stock-based compensation, which is essentially restricted stock units or stock options that essentially dilute the company's overall shares, but are a form of compensation that I would say are extra rewarding other than just your basic salary, right? This is what gets people to work. This is what gets the smartest people in the world out of bed every day. Look at most of the employees at NVIDIA, right? They're all multi-millionaires because of this right here, stock-based comp. So let's see, you can add back any restructuring cost, and you add back any legal fees, right? These are all 1x, one-off expenses, right? Eventually you'll get to adjusted EBITDA. And we're gonna further kind of drill down into what exactly adjusted EBITDA is, but essentially it's a level of normalized cash flow that you can compare across businesses within the same sector, right? It doesn't include anything like interest expense or interest income, taxes, right? Which can vary across companies in the same industry. So it normalizes a level of income that you can rely upon for accuracy. So we'll do adjusted EBITDA margin. And now down here we'll do growth rates and margins. Perfect. Sorry, I know this is a lot of formatting, but this is how you set up a model. And eventually I'll lose my job and AI will just be able to do all this, right? So I'm sure, in a year or two, people will be able to say, hey, AI, scrape this video and scrape the formatting and everything. And, I'll be obsolete. All right. Let's actually start punching in some of these numbers. So for May 3rd, 2025, they did. These are in thousands, by the way, right? So this is actually how much revenue they did. Sorry, these are in millions. These are these are in millions. So you take this, multiply it by a million. They did 3,463,000,000 in revenue. And I'm sure, obviously they rounded this, but I'm sure there's, multiple decimal points there. So cost of goods sold, about 2 billion, and you just sum this and you get your gross profit. Now, this is the most important line on the income statement is gross profit. More importantly, this as a percentage form is gross margin. That is your most important. That is what C-suite is looking at. How can we increase gross margins? Is it, do we increase gross margins by keeping costs static, whether it be expenses or actual cost of goods sold? Do we renegotiate with vendors? And essentially that would be one way to grow margins is to keep costs flat while you grow revenue, or costs are increasing as revenue grows, which is very common with any growing businesses. But revenue is growing so fast that you've reached some point of scale and you have some operating leverage. That's another way to increase gross margin. So any operating expenses, they just, this is like selling expenses, marketing expenses, general and administrative expenses. Sorry, I just got a work email here, and whatnot. But they've sort of lumped all of those into this one all-encompassing line item here, just OPEX, operating expenses. So this is operating income. You can see they did 260 million in operating income. Their interest expense, they pay 23 million in interest expense, and interest income, 26 million. We will sum these. Here is their pre-tax income. So interest income, wow, we'll have to look that up. Taxes, they pay 70 million in taxes. Uncle Sam, right? Does nothing with this money, by the way. Diluted shares outstanding, they have 382 million shares outstanding. And we'll make all of these. Use the currency format for all of these. Perfect. Okay. There you go. Earnings per share, 51 cents. Not bad. Take their operating income again. So depreciation and amortization is typically embedded within, the expenses. So it'd be either in this line or this line, the cost of goods sold or the expenses. And typically you have to look at the cash flow statement to actually gain some color on what that figure is. Sometimes they'll include it in the income statement, sometimes they'll make you dig for it. So we can go look for this, which will be right in the cash flow statement, cash flow from operations. And here we go, they had 121 million in depreciation and amortization. So, and again, that is a non-cash expense, right? When you depreciate something, it's an accounting, it's a GAAP accounting exercise. Accountants develop this depreciation methodology to align revenues with expenses or expenses with revenues, right? Um, if one quarter you generate $10, but essentially you say you spend I don't know, $50 on machinery and equipment, right? You don't want to recognize that $50. It would completely offset and skew the financials for that quarter. So essentially, you straight line depreciate that $50 over 10 years. So maybe you recognize an expense of $3 on the income statement. Or maybe that would be more like 20 years, but you get the point. It just sort of makes sense after you understand it. There's EBITDA. Stock-based compensation is also on the cash flow statement, 37 million. And we'll do a search for restructuring. So I don't see any restructuring. I don't see any kind of restructuring, so we'll zero that out. Legal fees, I don't see either. So this will be our adjusted EBITDA. Adjusted EBITDA margin. Don't need to go all the way up there. Just take the adjusted EBITDA level and divide it by revenue. And we will turn this into a percentage. Perfect. Perfect. 12%. That's pretty nice. Again, all these figures are you need to compare them across different competitors, comps from the industry, trading comps, but these are nice numbers to arrive at. All right, so we'll do revenue growth, we'll do year over year percentage, we'll do gross margin as a percentage, we'll do OPEX as a percentage of total revenue, and we'll toss in EBITDA margin. Perfect. Okay, not bad. These are all going to be percentages anyway, so perfect. Okay. And we are going to italicize these. Always italicize percentages, in my book at least. Boom. Okay, cool. Let's get this other quarter in. While we're on the cash flow statement, might as well just get these in. Cool. Revenue. Now we can start going a little bit faster here that we have everything set up. Perfect. Yeah, and they had 383 shares outstanding, 41 cents per share. So it's what, 124, and this was what, 27, what I remember? So it was cool. Okay, so you can see their EBITDA margin has expanded. So this is I'm not gonna comment because I don't want to get doxxed, but this is a good way to, you might want to write a note here. You know, they're certainly experiencing some margin expansion, we call that, not margin compression. If you were to flip-flop these, that would be margin compression. All right, I might have to end this early because someone needs my attention at work. So, gross margin. This is also really important, right? It's nice to just know straight up, every dollar that the company spends, what are they getting back? They're making 41% on their every dollar that they spend, right? That's pretty fucking good. That is pretty fucking good for an apparel company, especially Gap, right? They're not, you know, their brand is strong, but they're not like a Lululemon or some of these other high-end brands where, you know, these brands cater to a more of a high net worth, higher salaried consumer, and that consumer doesn't realize that they're paying for the same quality of clothing that Gap produces, but they're just willing to pay more because of the brand that Lululemon represents. It's just synonymous with quality and wealth. So people pay more for it. It's as simple as that, and it leads to higher margins. All right, but that is pretty good. That is pretty good. Now I want OPEX, operating expenses as a percentage of revenue, 34%. And lastly, we'll just do the EBITDA margin. Copy these. So you can see their operating expenses are also declining year over year, right? Which is obviously, this isn't going to affect gross margin at all because it's behind, you know, it's below that line item. But it will heavily impact EBITDA. And you're seeing that 11% versus 10% year over year. It's a great expansion. Great job. Now let's see what Gap is trading at now. I mean, I would imagine this would be trading higher. Yeah. So you can see this is on a buy program. Somebody is actively buying this. As of Thursday the 5th, somebody's been buying this. So this will go higher for sure. Not financial advice, but I would expect this to go higher. So that'll be it for now. I mean, I know it's just one quarter. I have to get back to work, and you know, but we will show you how to construct a balance sheet as well. It'd be easier just to do this probably. balance sheet. I'm getting bombarded by people right now, actually. Obviously, you start with assets, right? Start with assets, and the first asset is cash and cash equivalents. Typically, you add accounts receivable. Let's take a look at theirs, actually. They actually have short-term investments. That's how they are getting that interest income, I assume. And then they have merchandise inventory. So again, the balance sheet, assets are organized, and liabilities are organized, and at least assets are organized by liquidity, right? So whatever you can liquidate, the easiest is typically and convert it to cash is typically first, which is why cash is first. Add other current assets. Do they not have any? They don't have any accounts receivable? No, they must. They don't have any reference of accounts receivable on this 10Q. That is so weird. Total current assets, right? Just total current assets. Now you can add property, plant, and equipment, which is essentially accumulated capex, which is then depreciated. It is a long-term asset. This is, property, plant, and equipment. So this is factories, any machines that are used to stitch clothing, make clothing, probably presses and steamers and whatever else they have over there to make these clothing and to cut the fabric and mold the fabric. So we have other long-term assets. We have total assets, just like that. I mean, that's got to be the simplest asset side of a balance sheet that I've ever seen. That is weird. It's liabilities. So liabilities, we will start with accounts payable. Again, this is money owed to factories and vendors and expenses and other current liabilities. Current portion of operating leases. Great, 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 great. Current liabilities. All right. So that line right there is one of the most important lines on the balance sheet, and you can develop a lot of schedules around that. Typically, every company breaks down what exactly their long-term debt consists of. Is it convertible debt? Is it senior secured debt? What are the different tranches of debt? How much debt is outstanding? The maturity dates, the interest rates, right? Is it SOFR plus what? What's the spread? And they'll break that down for us. And we'll create schedules on that. Um, and if they don't provide us with the interest rate, then we can back into it. Um, Total liabilities. Okay, cool. Here we have the equity, assets minus liabilities, right? So we have common stock, what this is. Additional paid-in capital. We have, finally, retained earnings, right, which is essentially just aggregated net income since inception. How much money has the company made? Which really isn't, it's obvious net income is not cash. You have to do all of the non-cash adjustments to get actual cash flow, but retained earnings is just net income. Looking at net income, is the company, from a net income perspective, are they profitable or are they not? Total equity, perfect. Okay. And sorry, I'm getting bombarded here at work. Essentially, this is another really important balance sheet line right here, additional paid-in capital. This will represent, if a company were to go to the secondary offering, right, contract an investment bank and issue shares to raise equity, right, to raise cash via equity, they would essentially be assigned a par value of $1, all of these shares, and let's say they were sold at a, whatever the market thinks is a fair value. Let's say they were sold at market price, $23 a share. You would essentially have in excess of $22 per share times however many shares were issued, and that would be additional paid-in capital, right? All right, let's get this filled out really quick. So cash equivalents, almost 2 billion. Short-term investments. Just gonna do this fast. Oh, you missed something. Cool. Oh, how did that happen? Okay. Perfect. Lines up. Liabilities. We start with accounts payable. Cool. They have almost 1.5 billion in long-term debt, which is just insane. Total liabilities 5.3, 5.4. What am I missing here? There we go. Okay. balance sheet KPIs, cash per share, book value. Yeah, this is where you can do inventory turn and accounts receivable, outstanding, days outstanding for all of the assets and liabilities. But I actually do this underneath the cash flow statement. That's gonna have to be it for me for now. I actually have to get back to work, but I did just want to show you that I'm working on GAAP. And let's take one last look at the share price. Share price today still up about 1.6%. So that'll be it for me. I hope you guys have a wonderful day, and I will upload more on GAAP soon.